Hello and good morning, folks. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And I shall begin my session today with wonder and admiration for these markets as to how smallest of the things can bring in moves in various assets and instruments. Recently, a mere rate check by the central Japanese central bank, a check where they just call up banks and ask for buying and selling levels, showed the participants taking action on expectations of an intervention. Apparently, yen rallied 1% with the update, while there may be more causalities that one can pin down. Not just that, we have seen quite an interesting move yesterday where the equity indices opened a gap down, but all the gap down was recovered, and we've seen quite an interesting bullish action by the participants in the markets. Though the FI interest was of the net sellers, there were other participants which propped up the equity index. And on the other hand, the energy crisis was seemed to have reached Japanese economy and had put them on toes, as they saw a soaring trade deficit on the backdrop of high energy prices. While on the domestic front, again, we have been hearing rumors of the beginning of sugar exports again in tranches, while we had the services data release. So there's a lot of things going on. And JK, I'd like your update on how should we be moving around with these kind of updates and market participants acting on so impulsively with smallest of the updates, as well as with their higher intensity.
Yeah, actually, it's a period of extreme volatility, and the volatility is not just in the prices, but also in the news itself. So we have, bullish news followed by bearish news, and just a few weeks back, we had market assuming that based on inflation expectations and few other numbers, particularly the PCE core index, market had assumed that it was close to its put, but the CPI number this week changed all that. Yeah, following huge moves on Tuesday, yields were somewhat less volatile yesterday, though they made a new high, came back. The yield curve is further inverted to 38.5 BPs. Stocks had no meaningful retracement after the staggering sell-off of Tuesday, and European stocks also closed lower for second straight day, with the comments from officials being the main mover. PPI, which came in line with expectation in US, did not have much influence on the markets. Now, though probabilities of Fed raising rates by 1% has risen to 30% after the shocking jump in CPI, there is equal focus on what the other central banks are doing or saying. So the currency space is actually getting more interesting now. In fact, I am seeing a hot duel starting between the markets and the central banks. The currencies are no more a product of benign neglect by CBs, who for all these years encourage weakness to gain the advantage in trade. And now they are averse to the inflation impact of weak currencies. Chinese actually fixed their yuan daily rate at the most deviated level from market expectation, which is a clear indication that they do not want further weakness in the yuan. Then, as you mentioned, Japan conducted a rate check in apparent preparation for currency intervention, as per the Nikkei newspaper, and also stepped up their verbal rhetoric. Yen did react by strengthening 2%, but few in the market believe that there will be actual intervention. I am more closely looking at the moves in the 10-year JGBs, which is now at exactly 0.25%. And any break higher in that will be a bigger indication of strength in the yen. ECB member also said that they will continue to raise interest rate at several meetings in this year. 2% being indicated as a neutral rate, and about 2% will be actual tightening. Of course, Eurozone industrial production came much weaker. Euro slowly getting again capped above parity now. And we also had the which indicating GDP world GDP to grow by 2.4%, which is a revision of 0.5% since the June report. And the Eurozone and UK are now expected to enter recession in this year, while there may be a mild recession in US in 2023. We'll have a data heavy day today, and that will be US retail sales, then manufacturing surveys by Philly Fed and Empire State Manufacturing, and jobless claims and industrial production. Retail sales and industrial production are expected to somewhat weaken, but I don't think that will have much of an impact on the markets or the currencies. Now, every focus is on the September 21st meeting by the Fed. There is no speeches by any of the Fed members because now they are in the blackout period. So market might be holding its breath till the Fed meeting next week, and possibly debating whether it's going to be 1% or 0.75, which has shifted from 0.5 to 0.75. I don't think other data will between now and then will matter much for the markets. On the stocks, definitely they look more wobbly now, possibly because one of the reports indicate the stock market going further down will actually tighten financial conditions more and lead to a slowdown in the economy, and that is what probably the Fed is trying to achieve by hiking rates. So it's a still a debate, how much they have to raise, but definitely right now they are on a very strong rate raising path. Indian markets, of course, have continued to outperform others, be it the stocks, bonds, or the currency. Currency did open with gap up, but good selling was even seen even ahead of 79.60 levels. Only buying was seen only at the 79.40 levels from importers who had missed out the earlier dip, and stocks, of course, definitely been a really cynosure of a rise, because amid all the bloodbath in other markets, we have been almost inching towards new all-time highs. There's an important development in the forward market where the 10-year has slipped to 2.25% or 2.25 rupees for 1 year. It's a 10-year low rather. So 1 year premium has fallen to 10-year low of 2.25 rupees or 2.83%. And this is reacting to short-term US yield rising after the CPI data. Historically, it's highly correlated to 1 year treasury yield in the US, and that has now hit a new cycle high at 3.94%. Just for a perspective, this yield was at 0.68% just a year ago, and this might have policy implication for the RBI. If the rupee's attraction needs to be maintained, they will have to hike the policy rate at least by 0.5% when they meet later this month. Thank you.
Okay, JK, that was quite interesting. And yes, the USD-INR forward premium has dropped down to its 10-year low, and it's quite interesting of a move on the backdrop of all the rising interest rates between the central banks and the reducing interest rate differentials. So, folks, on the exporter side, be prepared to receive lesser premiums, or while the importers can enjoy some bit of a good import payments. While there was another update that JK mentioned, that there was further yield curve inversion, which was interesting to see, as it has always been a widespread indicator of an upcoming recession. But at the same time, when we say Indian markets, it has been quite resilient. Indian markets have been outperforming, as JK mentioned, on the currency, equities, or on the bond sides as well. So it's good to see India performing. But I really like one bit that JK you mentioned, was the fact that there's a hot duel between the market participants and the central banks, as the central banks are trying to stave off any imported inflation due to the currency weakness. So it needs to be seen how things are going to go ahead, and what sort of moves that we are going to see in the markets. We'll come up again tomorrow morning with another set of update, folks. Till then, we say goodbye and thank you so much for listening.